It's time for Business Blueprints, from pixels to patterns. This is where we break down the journey of tomorrow's titans. Welcome back to the deep dive, focusing very much on wealth building and, investment strategies.
Yeah, we've pulled out some really significant insights, especially from recent chats with the investor Manish Pabrai, particularly from his appearances on My First Million.
Right, and we've also woven in perspectives from some of the other materials provided, things that complement or maybe even challenge those ideas a bit.
And our mission today, it's pretty clear, right? We want to pull out the core principles, the actionable stuff from all this material.
Exactly. How do you really approach investing and building wealth? Specifically looking at getting those, substantial returns. The sources talk about that big 100x goal.
Yeah, that 100x. And how to find those unique, often kind of overlooked opportunities. Plus, there's this fascinating bit about the link between thinking like an entrepreneur and being a smart investor.
Definitely. And just a reminder for everyone listening, our role here is to guide you through these sources. We're presenting the information factually, exploring the ideas, even the ones that might seem challenging or maybe contradictory.
But we're not endorsing them. It's about understanding the perspective in the material itself. We're just laying it out for you.
Okay, so let's jump in. That central question, the one driving a lot of this discussion. How do you take, say, $10,000 and turn it into $1 million?
Right, that's the big one, the 100x return mission. The sources really frame this as the core challenge they're trying to provide a blueprint for.
10,000 to $1 million. It's the dream for a lot of people, isn't it? The sources break this down into two paths, basically, Plan B and Plan A.
And critically, Plan B isn't just like an option. It's presented as the absolute starting point, the foundation. You kind of have to build on this layer first.
Okay, so what is Plan B?
Plan B is all about steady, consistent compounding. It sounds boring, maybe, but it's powerful. The source really hammers this home. Before you multiply capital, you gotta have capital.
Makes sense. So step one is accumulation.
Exactly. That means, having a job, earning income, and maybe even more important, spending less than you earn. Consistently. That gap, that surplus, that's your starting capital.
So you save up some money, maybe $5,000, $10,000 a year, whatever works for you. Then what?
Then the default strategy, the Plan B, is to put those savings diligently into a sensible long-term investment. Often that means a broad index fund.
Okay, like the S&P 500.
Right. But there's a specific point made in the sources about the timing, like around 2025. They suggest that maybe the S&P 500 is looking a bit overheated then.
Overheated, meaning what? Too expensive, less likely to give good returns going forward.
Yeah, basically. Based on valuation metrics discussed in the material, the idea is the market might be priced too high, suggesting maybe lower future returns or, more risk of a drop.
So if not the S&P 500 in that specific context, what's the alternative Plan B?
The sources specifically mention Berkshire Hathaway Class B shares as a potential alternative default index around that time.
Ah, Buffett's company. Why Berkshire?
Well, the thinking presented is that it's a diverse collection of good businesses, managed by, arguably the best capital allocators ever. So for long-term compounding, it might be seen as more stable or maybe more prudently managed than a potentially overheated broad market index.
Okay, so you start saving, put maybe $10,000 in, keep adding your savings each year to this default like Berkshire. How does that $10K actually become $1 million? It still feels like a huge leap.
It does, but this is where compounding really kicks in, and the sources highlight a super simple tool to understand it, the Rule of 72.
Ah, the Rule of 72. I've heard of this. It's like a quick mental shortcut, right?
Exactly. Not perfectly precise, but really useful. You just take the number 72, divide it by your expected annual return percentage, and that gives you roughly how many years it takes for your money to double.
Okay, so let's use the Berkshire example from the source. They suggest, maybe a 10% annual return is reasonable long-term?
Yeah, let's say 10%. So 72 divided by 10 is 7.2. The source kind of rounds it to 7 years for simplicity in the illustration. So your money roughly doubles every 7 years at a 10% return.
Okay, let's track that initial $10,000.
Yeah.
After 7 years, it's $20K.
Right.
After 14 years, $40. 21 years, $80K. 28 years, $160K. 35 years, $320K. 42 years, $640K. And then 49 years. That's 7 doubles. It's $1,280,000.
Exactly, just from the initial 10 grand. And remember, you're also adding your annual savings over those decades, and those savings are compounding too. The source estimates the total could easily top $1.3 million.
Wow, so the big takeaway from Plan B is It actually works. You can get to that 100x goal, that $1 million from 10,000, just by saving consistently and letting it compound in something sensible over decades.
Without needing to be a genius trader or anything. It's about patience and consistency, time in the market.
And the source mentioned something about a tax advantage with Berkshire specifically.
Yeah, because Berkshire doesn't pay a dividend. For someone compounding long-term, that's potentially helpful because you don't pay taxes on dividends each year. The whole amount keeps compounding, tax-deferred, until you eventually sell way down the line. Could give a little extra boost.
So Plan B feels very accessible. Focus on earning, save the difference, invest it consistently in something boring but solid. Anyone can start that.
It's the foundation. Absolutely essential. But then there's Plan A.
Right. Plan A is the accelerator, they call it.
Yeah, this is where you actively look for what the source calls unusual opportunities or anomalies, those rare fat pitches.
Unusual opportunities. What does that actually mean? What do they look like? Are they super complex?
No, actually the opposite. That's the surprising thing. The sources say these anomalies often make no sense at first glance. The numbers might look wrong or too good to be true, or the whole situation is just weird.
Weird how?
Just doesn't fit the normal market patterns. But when you figure it out, when you understand why it's weird, the source says it hits you like a 2x4. It becomes blindingly obvious.
Obvious in retrospect, maybe. How do you know if it's a genuinely great idea or just something complicated you think you understand?
Simplicity is the key test. The source puts it really clearly. If you can't explain the core reason why this is a great investment to a 10-year-old in like 4 or 5 simple sentences, then it's probably too complex.
So forget the fancy spreadsheets.
Pretty much. The source says if you need complex models or heavy Excel work to justify the idea, it's likely an automatic pass. Why? Because you'll never have that deep gut-level conviction you need if the thesis is that complicated. They even connect it to Einstein. You know, the idea that true intelligence is making things simple.
Okay, so simple, obvious once you see it, kind of too good to be true. Sounds amazing.
Yeah,
Are these things common?
Not at all. That's the catch. Truly great investment ideas are incredibly rare. The source uses Buffett's own track record at Berkshire to really drive this home.
How so?
In, 58 years? Only about 12 decisions are said to have really moved the needle for Berkshire's overall value. 12.
12 major wins in almost 60 years.
Yes.
That's leavenable.
Yeah, it works out to like a 4% hit rate on major decisions, or roughly one truly significant game-changing idea every 5 years, on average.
One every 5 years. Okay, that definitely frames rare. Explains why patience is so important. You can't force these things.
Exactly. You wait for the fat pitch. And when you find one of these rare, simple, asymmetric anomalies, the strategy outlined is to take a portion, maybe 10%, 15% from your Plan B default investment.
Like the Berkshire shares or the index fund?
And put it into this high-conviction Plan A opportunity.
And then what? Just let it ride.
Let it play out. If it works and gives you those outsized returns, you can then take the profits and potentially cycle them back into your solid Plan B base.
So Plan A boosts the capital in Plan B, speeding up the overall compounding.
That's the idea. Plan B is the reliable engine. Plan A is like the turbocharger you use occasionally. Get a few Plan A wins over your investing lifetime, and you could potentially hit that 100x goal much faster, maybe half the time or less, compared to just sticking with Plan B alone.
It definitely requires a different approach than Plan B, though. Plan B is consistency. Plan A sounds like patient vigilance, deep bursts of research, and then decisive action when something clicks.
Totally different mindset. You have to be comfortable doing nothing most of the time, but ready to act big when the rare opportunity appears.
Okay, so Plan B is the steady foundation. Plan A is the rare accelerator. But how do you actually find these Plan A anomalies if they're so rare? Where do you even start looking?
Yeah, that's a practical question, isn't it? The sources emphasize that temperament is probably more crucial than just being smart.
Temperament, meaning?
Patience, mainly. The ability to sit still and do nothing for long periods, and a willingness, maybe even a preference for looking in places other people are ignoring or actively running away from.
Like looking where the trouble is?
Exactly. The sources use some great historical examples. Think about young Warren Buffett, before he was famous, going to the racetrack.
Right, you mentioned this. Not to bet, but to sift through discarded tickets.
Yeah, looking for winning tickets people have mistakenly thrown away. Finding value in literal trash where everyone else saw only loss. That's the mindset.
Or the image of him later, poring over those old Moody's manuals.
Dusty old books filled with company financials, page by page. Tedious work, looking for tiny statistical discrepancies no one else had the patience to find. There's a real sense of nostalgia in the sources for that kind of deep physical digging.
Okay, but most of us aren't going to do that today, right?
Mhm.
Who has the time or, frankly, the intensity for that?
Right, the sources acknowledge that. Very few people have that Buffett-level intensity. So thankfully, they mention some modern shortcuts or tools that can help surface potential ideas.
Like what?
One specific resource highlighted is a website called Value Investors Club.
Value Investors Club. What is it?
It's basically a curated community where smart investors submit their best, well-researched investment ideas. It's members only to submit, and you need decent ratings from other members to stay in, so there's a quality filter.
Okay, sounds exclusive. Can regular people access it?
Here's the great part. Any investment idea that's been on the site for 60 days or more becomes publicly accessible, free for anyone to read.
Okay. So you get access to older, but potentially still very relevant, deep dive research from smart people.
Exactly. The source calls it a place with brain power coming out of their ears. Instead of starting from scratch, you can scan through these detailed write-ups, read the first few paragraphs, see if the idea clicks or if it's in an area you understand.
That sounds way more efficient than reading Moody's manuals page by page.
Massively more efficient. The source suggests you could realistically review, say, 4 or 5 interesting ideas a day just by scanning these write-ups, even with a full-time job.
But then I'm guessing but you don't just read the write-up and buy the stock, right?
Absolutely not. This is critical. The sources are adamant. These are idea inputs, not by recommendations. You must do your own research, your own homework.
You have to understand the business yourself, make sure it's in your circle of competence.
Yes, you have to understand it inside and out, confirm it's something you actually get, and form your own conviction. Independent thinking is non-negotiable.
It's like getting a hot tip, but then you have to verify everything yourself before acting. The source mentioned an example of an idea from 2021 still being valid in 2025.
Yeah, illustrating that good fundamental analysis about a business can have a really long shelf life. Even if the market price bounces around, the underlying value proposition might remain intact for years.
Okay, so Value Investors Club is one tool. Any others mentioned?
Another one linked to a famous Buffett investment is the Japan Company Handbook.
Like the Moody's manuals, but for Japanese companies.
Pretty much. Just straightforward directories with financial data. And it was apparently by looking through these that the big investment opportunity in Japanese trading companies jumped out.
The one described as a total no-brainer.
That's the one. And
Wow.
remember, for a true anomaly, that's how it should feel, but only after you've done the work and understood the simple core thesis.
So what made the Japanese trading companies a no-brainer? Let's break that down again.
Okay, a few key things came together. First, these big established companies were trading really cheap, especially after Japan's market had been kind of stagnant for decades.
Okay, cheap stocks.
Second, and this was huge, they were paying high dividend yields, like 8% on average. That's a lot of cash coming back to you each year relative to the stock price.
Cheap stocks, high dividends. Sounds good, but what was the kicker? The asymmetric part.
The financing. Buffett borrowed the money to buy them about $5 billion worth in Japanese yen. And because interest rates in Japan were incredibly low, he borrowed it at just 0.5% annual interest.
0.5%. That's almost free money.
Practically. So think about the math. You borrow $5 billion at 0.5%, costing you $25 million a year in interest.
Okay.
But you invest that $5 billion into stocks paying an 8% dividend yield, which brings in $400 million a year in dividends.
Whoa, so you're paying $25 million to get $400 million back just in cash flow before any stock price movement.
Precisely. The dividend income covered the interest cost 16 times over. And since the whole thing was funded with borrowed money, the source describes it as having no equity invested initially, leading to an infinite return on capital just from that dividend interest spread.
That's incredible asymmetry. Massive cash flow upside with minimal initial risk thanks to the cheap debt.
And it didn't stop there. The stocks themselves doubled in price over the next few years, turning the $5 billion value into $10 billion. Plus, the companies raised their dividends, so yield on the original purchase price went up to around 15%.
And Buffett bought more over time, the source said.
He did. The opportunity remained compelling. And again, the point is, this wasn't hidden information. It was there in public handbooks for anyone looking with the right framework and patience.
This really ties into that other principle they discussed. Know a lot about a little.
Exactly. If you decide you want to understand, say, shipping, you go deep. Tankers, bulk carriers, containers, the history, the cycles, the regulations, everything. Become a world expert on just shipping.
but you ignore airlines, software, everything else. Total focus.
Right. Avoid distraction. Go deep in that 2-mile radius. Because when you know an area that well, you're far more likely to spot those anomalies, those discrepancies that others miss.
It sounds like a simple blueprint.
Yeah.
Pick an area, go super deep, find the weird opportunities, maybe hold great ones forever. Why don't more people do it if it's that straightforward?
Well, the source suggests it's just hard. It requires intense focus and the discipline to ignore almost everything else. Most people get easily distracted, want to chase the next shiny thing. That kind of singular focus runs counter to how many of us operate today.
Yeah, makes sense. Hey, if you're finding this breakdown valuable, definitely drop a like and share it. It helps others find this kind of focused analysis. Let's shift gears a bit. The sources talk a lot about the connection between being a good business person, an entrepreneur, and being a good investor. They seem deeply linked.
Oh, absolutely. It's fundamental to the philosophy presented. Buffett's quote really nails it. I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor.
Why is that connection so strong? What's the overlap?
The idea presented is that they use the exact same part of the brain. Think about what an entrepreneur does. Maybe 3–5% of their time is pure strategy. What's the product? Who's the customer? How do we price it, market it? The rest is execution.
Okay.
But for an investor evaluating a company, that strategic figuring out the business part becomes like 80% of the job. You're constantly analyzing business models, competition, management, how they allocate capital. You're using the entrepreneur's strategic toolkit all the time.
So having actual business experience helps you analyze investments better.
Hugely. And the sources emphasize getting that experience early, like between ages 11 and 20. Think about young Buffett again selling Cokes, paper rows, pinball machines before he was even 17. He was learning business fundamentals hands-on.
They even mentioned that lemonade stand test, right? Looking for CEOs who ran something simple as a kid.
Yeah, the idea is that running even a basic lemonade stand teaches you so much. Location, pricing, inventory, marketing, customers, profit, loss. It builds an intuition for business early on that someone who hasn't done that might lack.
The sources gave other examples too, didn't they? Like flipping stuff on eBay?
Right, or competitive video games, learning strategy and competition. Even things like a Mormon mission, teaching sales and handling rejection. Or Saivaki, selling greeting cards and coding games really young. It's about developing that figure-it-out muscle early.
Pabrai's own story fits this too, but in reverse almost. He initially avoided entrepreneurship.
Yeah, because he saw his dad struggle too much debt, couldn't withstand downturns. It made him wary.
But his dad eventually pushed him into it.
Right, his dad saw he was feeling constrained in a big company. So Pabrai took $30K from his 401k and started an IT business in the early 90s, focusing on a specific niche, client-server computing.
And that story highlights another key point. Entrepreneurs aren't necessarily huge risk takers.
Exactly. That's a common misconception. The sources argue great entrepreneurs do everything possible to minimize risk.
Like the Buffett pinball machine story.
Yeah.
Start small, reinvest profits.
Perfect example. Just $25 for one machine, use its profits to buy the next one. Minimal capital exposed initially, scale using cash flow, not massive debt or outside funding. It's low-risk, high-return thinking.
Totally different from the typical venture capital model of raise big, spend big, hope for a huge exit.
Very different. And the Richard Branson Virgin Atlantic example is maybe the ultimate case study in this risk minimization through creativity, starting an airline with basically no money.
How did he pull that off again? It sounds impossible.
Well, instead of buying planes, he leased one that was just sitting parked. Smart.
Yeah.
And he used negative working capital.
Meaning he got paid before he had to pay his bills.
Exactly. Sold tickets way in advance, collected the cash up front, but he didn't have to pay for fuel or the plane lease until later. His customers were effectively financing the airline's launch interest-free. Brilliant risk reduction.
If you can figure out how to start an airline that way.
The source argues you can apply that same creative, risk-minimizing mindset to starting almost any business, or, importantly, to evaluating the real risks in an investment.
So, adopting that entrepreneurial lens, looking for simple models, finding creative ways to limit the downside, gives you a real edge when you look at stocks or other investments.
It helps you see the underlying business mechanics and risks much more clearly.
Makes total sense. And hey, if you want more deep dives that connect these kinds of ideas, definitely subscribe to the Snippet Labs YouTube channel. Okay, let's drill down into some of the core investment philosophies that kept coming up in these sources, illustrated by those examples we've discussed. One big one is the heads I win, tails I don't lose much idea.
Yeah, that's really the goal, isn't it? Finding those asymmetric bets. Opportunities where the upside potential is huge, like multiples of your money, but the downside is somehow capped or protected.
The sources called it the Dando philosophy, linked to the Patel community.
Right, associated with their reputation for shrewd, low-risk, high-return business practices. It's about finding situations where you have a built-in margin of safety.
Like Pabrai starting his business, limited downside, could get a job back, massive potential upside, valuable company.
Or that IPSCO steel example, that's a classic. Let's recap the asymmetry there.
Okay, Canadian Steel Company, stock was $45, trading cheap, like 3x earnings.
Key points: $15 per share in cash on the balance sheet, no debt, and, crucially, guaranteed contracts locking in $15 per share in earnings for the next 2 years.
Right, so the math. Buy at $45, subtract the $15 cash, you're effectively paying $30 for the actual business.
A business that is contractually guaranteed to earn $30, $15 by 2 years over the next 24 months. So you pay $30, you get $30 back in guaranteed earnings relatively quickly, and you still own the steel plants and everything else. Your downside is massively protected.
Yeah, what happened?
The investor bought in. After a year, they announced another year of guaranteed earnings, confirming the value. The stock doubled to $90 just on the market recognizing this.
Great return already.
But then a Swedish company came in and bought the whole thing for $160 a share.
Wow. $45 to $160. That's the heads I win part in action.
Yeah.
The low initial price provided the tails I don't lose much safety net.
Exactly. The market eventually figured it out, and the acquisition provided the massive upside.
And the RAS example, the Turkish warehouse operator, was even more extreme asymmetry, wasn't it?
Oh, yeah. Market cap was tiny, just $16 million in 2019.
But the estimated liquidation value of its warehouses minus debt was way higher.
Around $800 million, based on the source's research. A staggering 50-to-1 difference between market price and asset value.
So outlier cheap, as they call it.
Totally. The investor did the work, visited Turkey, met management, confirmed good clients, inflation-linked leases, found the business was solid.
So the math was just crazy. Buying $8 million worth got you a third of the company.
Effectively buying $266 million worth of liquidation value for just $8 million. Extreme discount, huge margin of safety from the assets.
And despite the Turkish lira collapsing.
Yeah, the currency went from 5 to 33 against the dollar, which is normally disastrous for a foreign investment. But the underlying business grew. Its asset value potentially hit $1.5 or $2 billion.
And the stock price
Rose to a market cap around $500 million in 4 years. That initial $8 million stick turned into something like $240 million, roughly a 30x return in dollars, even with the currency headwind.
Incredible. Shows the power of buying based on intrinsic value at a massive discount. The low starting price limited the downside relative to assets, and the business growth provided the explosive upside.
It perfectly illustrates that low-risk asset protection, high uncertainty, Turkey overlooked stock, leading to high rewards.
Which ties into that other philosophy. Trouble is opportunity, the John Templeton quote.
Be fearful when others are greedy, greedy when others are fearful. It's the contrarian mindset. The best asymmetric bets often show up in places that are hated, unloved, or facing big problems in the market's eyes.
Like the coal industry example. Widely disliked due to ESG.
Right. Because everyone was avoiding it, the prices got ridiculous. The sources mentioned businesses generating $1 billion a year in cash, expected to last 50 years, selling for a total market cap under $2 billion.
Paying less than 2 years' profit for decades of cash flow. Just because the industry is out of favor.
That's the kind of disconnect trouble creates. The negative sentiment was the opportunity.
Why do these huge mispricings happen more in public stocks than, say, private businesses or houses?
Public markets are auction-driven, the sources say. Highly emotional, driven by sentiment, news cycles, herd behavior. Your house value doesn't jump 20% because of a news headline, but a stock can. That irrationality creates openings for rational, patient investors.
So look for trouble. Look where others aren't looking. Companies coming out of bankruptcy. Industries everyone hates.
That's where mispricing often hides. Find the fear, find the neglect, and you might find the asymmetry.
Got it. And hey, for more updates on finding value in unexpected places, follow us on Twitter @SnippetLabs. Now, this might sound weird, but the sources argue that sometimes the best way to get high returns is to do nothing. Inactivity.
Yeah, it's deeply counterintuitive in our hyperactive world, but it's a core principle. Buffett's circle the wagons idea, or what they call the paint drying decision.
The paint drying decision.
Meaning, after you've done the hard work, found a truly great business, and invested, often the most profitable next step is just letting the paint dry, doing nothing, not selling.
Because Buffett's biggest wins weren't just buying right, but holding for decades. Sees Candy 50 years, Coke 40-plus years.
Exactly. The holding is where the magic of compounding happens. Selling too early, even great companies, cuts that short.
The Nick Sleep story fits here too, right? The fund manager who went super deep on reading annual reports.
Yeah, him and his partner, they lived that know a lot about a little ethos, found Amazon early, saw past the high PE because they understood Bezos was reinvesting brilliantly for the future.
And they got super concentrated in just a few names, like Amazon, Berkshire, Costco.
So concentrated that when regulators pushed them to diversify, they actually returned capital to investors and concentrated their own money even more.
Wow, that's conviction.
And the lesson is, leave great businesses alone. Let them run, even if they become a huge part of your portfolio. The source notes even Sleep selling some Amazon later wasn't as good as just holding it all. Inactivity on great holdings is key.
Like Pabre, intending to hold RES as long as the family runs it well, ignoring the stock price noise.
Right. The big money is often made in the sitting, not the trading.
The sources also talked about the skill of capital allocation itself. Not just running a business, but deciding where to put the money within the business.
Yeah, it's a distinct, crucial skill. Bezos at Amazon is the classic example, making lots of small, low-risk bets like AWS early on, knowing some would fail, Fire Phone, but the winners could be enormous, always investing ahead.
And Zuckerberg at Meta recently shifting focus, from maybe being less disciplined to becoming super frugal and ROI focused.
Right, adopting that Patel-like frugality, the source called it, showing that capital allocation mindset can change and have a big impact.
But maybe the most powerful capital allocation example wasn't buying assets, but hiring people. Ajit Jain at Berkshire.
Oh, absolutely. Hired in '85 to run reinsurance with no insurance background. Munger called hiring him possibly the single best investment Berkshire ever made, created over $100 billion in value from scratch.
Just by allocating capital to one exceptional person.
Shows the immense leverage in finding truly great human capital.
Which connects to that broader point about people and investments. There's an infinite supply of good ones.
The idea is you don't lose anything by passing on a person or investment you don't fully understand. There are plenty more fish in the sea. No penalty for saying, I don't get it.
But the cost of bringing in the wrong person or making the wrong investment because you didn't understand it
This is huge. So many drains, the source says. It drags everything down. Much better to miss a potential winner you didn't grasp than to invest in a loser you misunderstood.
That's the no-call strikes baseball analogy, right? You don't have to swing at every pitch.
Yeah.
Just wait for the perfect one in your sweet spot.
Exactly. Let the tough pitches go by. Put them in the too hard pile.
So patience, inactivity on winners, recognizing great capital allocation in businesses and people, and the discipline to say no or too hard, those are really crucial, often overlooked skills.
Foundational for long-term success.
Absolutely. Drop a like and share if you find this valuable mastering that inactivity takes real discipline. Okay, we've covered strategies, finding ideas, the entrepreneurial link. Let's talk about the psychological side. Temperament, conviction, understanding the game. The sources really emphasize this.
Hugely important. One key distinction they drew was between risk and uncertainty. Wall Street often mixes them up.
How are they different, according to the sources?
Risk is the potential for permanent loss of capital. Uncertainty is just not knowing exactly what the future holds. And the sweet spot for high returns is often found where there's low risk but high uncertainty.
Because Wall Street hates uncertainty.
Generally, yes. They prefer predictable businesses, even if they're expensive. Low uncertainty, maybe high risk if overpriced. Situations with high uncertainty, geopolitical stuff, industry cycles, turnarounds make them nervous. They often sell those off cheap, take them out back and shoot them, creating opportunities.
Like the shipping example. High uncertainty about rates, but low risk because the ships themselves were worth more than the stock price.
Perfect example. Uncertainty depressed the price, but asset value provided the low-risk safety net. High reward potential when uncertainty cleared.
Or the Turkish Coke bottler Pebrai owned. It fit initially.
Low risk, high uncertainty. But then the Russia situation, nationalizing assets, dramatically increased the uncertainty to a point where it became impossible to reasonably handicap.
So it went into the too hard pile.
Exactly. Even with a gain, the uncertainty became unmanageable. Shows the humility needed to know when you don't know and get out or stay out.
That too hard pile concept from Buffett seems really important. Just having a place to put things you don't understand.
It's critical self-awareness. The sources say 99% plus of ideas should probably go in there. You only need to understand a tiny fraction of the world really well to succeed. No shame in admitting ignorance on most things.
Yeah, conviction ties into this, right? Hard to have conviction if the idea is too complex.
Definitely. If you need a spreadsheet to remind yourself why you own something, your conviction is probably weak. The thesis needs to be simple, clear, internalized, in your head, as the source puts it. That's what lets you hold on during volatility.
There was also that story about the contest with 6,000 people. What was the insight there?
It was fascinating. The host running it realized most people who entered didn't actually believe they could win. They thought the odds were too long, it was just for fun.
Because they weren't really playing seriously.
Right. Only a small fraction, maybe 5%, genuinely believed winning was possible and played strategically to win. So the real competition wasn't 6,000 people. It was maybe just those 300 or so who were truly in the game.
Applying that to investing or business, your real competition might be much smaller than you think.
Exactly. Most people aren't operating with that level of focused intent, discipline, and belief. If you do, your odds might be better than they seem.
And one last piece of psychological advice? Avoid stock tips from TV.
Oh, yeah. A huge, big red flag. The sources were very clear. It won't end well. It's the opposite of independent thought and conviction. They even joked about a reverse Kramer index.
Doing the opposite of the TV tips.
Basically, just highlighting how unreliable generic tips usually are. For most people, sticking to Plan B indexing is far safer.
So developing that right temperament, understanding risk versus uncertainty, humility, too hard pile, conviction from simplicity, belief in winning, and discipline about information sources, it's as important as the analysis itself.
Arguably more important in the long run.
Makes sense. Don't forget to subscribe to the Snippet Labs YouTube channel for more deep dives that simplify these complex ideas. Okay, let's try to wrap this all up. Let's synthesize the blueprint for wealth building and investing that emerges from all these sources.
All right. Step 1, absolutely non-negotiable. Build your capital foundation. Earn income, spend less, save the difference. Diligently.
Then implement Plan B. Consistent, boring, long-term indexing. Maybe Berkshire, maybe a broad index depending on the context. It's something solid for steady compounding. That's your base.
While that base compounds, you cultivate Plan A vigilance. You patiently, actively look for those rare, simple, asymmetric, fat pitch opportunities, often in hated, overlooked areas. But remember, do your own work.
And think like an entrepreneur. Use that business analysis brain. Focus on simple models, minimize downside creatively, look for value gaps.
Then crucially, patience and inactivity. When you find a great business, let it run. The paint drying decision. Hold for the long term. Let compounding do its magic.
Know your circle of competence. Stick to what you truly understand. Be ruthless about using the too hard pile for everything else. Humility is key.
And finally, cultivate that temperament. Discipline, humility, conviction built on simplicity, contrarianism, belief, patience. Control your psychology.
And don't forget the sheer power of compounding, illustrated by the Rule of 72. Start early, even small, be consistent, let it be boring. The tortoise wins. Pabray's own early 401k shows this.
Yeah, and we saw glimpses of related ideas from others too. Ed Thorpe's quantitative approach, Junjunwala's mix of trading and long holds, the Patel's focus on cost advantage and generations, Jack Conte's challenging norms with first principles, different paths but overlapping principles.
And the core message seems to be that these aren't just stories for billionaires. These principles apply at any scale, starting with $10 or $20, whatever you have. It's about the process, the mindset, the discipline over time.
Exactly. It's a marathon built on saving, steady compounding, and that rare, carefully chosen acceleration from true anomalies.
So as we finish up, here's that final provocative thought for you to mull over. If the greatest investor of our time, Warren Buffett, only found about 12 truly needle-moving ideas in nearly 6 decades, what does that tell you about where your focus should probably be? Is it on chasing the next big thing every day, or is it on developing the ability to recognize the truly rare great opportunities when they appear, and then having the discipline and conviction to simply hold on to them? Ideas ignite empires. Pay attention to the sparks.